Have you heard about private credit? Let's dive into what it really is and why investors are starting to worry. The idea isn't new. Back in 1920, Edwin Lefebvre said speculation was as old as the hills. That same old idea made a comeback in the last decade, often under the headline of private credit. Big names like Blackstone, Apollo Markets, and newer upstarts such as Blue Owl pooled $1 trillion of investor money to loan to companies that traditional banks were now avoiding. The promise was clear: take on slightly higher risk, offer higher returns, and give sick, new or overlooked companies a chance to grow. The market grew fast. Private credit saw a surge in investors, savers, retirees, and individuals looking for better annual yields than what bond markets or bank deposits could provide. These firms attracted people with regular performance updates and the idea that they might cash out as needed. But the rapid expansion has come with growing pains. Since the start of this year, people have begun to fear that borrower companies, especially in software-adjacent businesses, might not make their repayments. Propose. Investors across the board are checking for spikes in default risk, and the biggest private credit players are now blocking redemptions. Blue Owl, for instance, recently imposed new withdrawal limits on a public fund that had already asked for a 38% lump sum exit. The move signals that the industry is no longer able to simply return money to investors as new money flows in, as many funds had done in the past. To understand why private credit grew, we need to go back to the 1980s, when high-interest junk bonds and distressed loan deals gained popularity. Banks used to do these through deposits, under strict regulation, but after the 2008 September financial crash, new laws tightened the bank's ability to extend high-risk loans. The demand for financing didn't vanish, so private equity firms stepped in and rebranded the activity as private credit. They could leverage money from investors, with the promise of higher returns, and lend to companies that had been turned away due to perceived risk. The real tension now is whether that model can sustain itself when borrower defaults rise. The core problem is that private credit often relies on continuous inflows of new capital to meet redemption requests. If default rates climb, those funds may struggle to keep investors' money safe. In short, private credit has become a high-stakes, high-yield alternative for investors, but the rapid growth, concentrated borrower base, and tightening regulatory environment have made many question the sustainability of the model. Thanks for listening. Stay tuned for more updates on this evolving scene, and take care.